From data centers to aerospace and biotech, this private credit company can help you invest in all of them. Let's dive in. Today, we are excited to have Trinity Capital CEO Kyle Brown with us. Thank you so much for joining us today, Kyle.
Thanks, Bridget. Thanks for having me.
Well, let's start with a little bit about what Trinity Capital is.
Sure. So we are an internally managed business development company. That is a fancy way of saying we are really an income play for investors. We lend money to growth-oriented businesses. Think kind of late-stage VC-backed companies into the lower middle market, private equity-backed companies. We provide kind of an array of products to those companies, but generally speaking, we're looking for companies that are growing at a 20 to 100% annual growth rate, who can utilize our capital to extend their runway as they achieve milestones and head towards a larger valuation. But we are private credit, very diversified across industries. Been at it since 2008 and providing great returns and really steady dividends during that time frame.
Yeah, let's talk about the growth of private credit over the past few years. There's really been an uptick in usage.
Yeah, we've always been private credit. The term private credit certainly has become more popular over the last few years. Companies are staying private longer. You have that dynamic that exists. You have banking volatility that really started a couple years ago, has led banks to lend less. There's more regulation, forcing their kind of max check sizes to reduce, along with just less deposits overall. So you see banks lending less, companies staying private longer. The relevance of private credit has certainly increased because the demand for capital is there. And so, we think that this is a really exciting time to be in private credit. We find ourselves in a really interesting niche that is different than I'd say the majority of private credit and alternative lenders out there who are focused on upper middle market, kind of larger profile companies. We think the lower middle market is a really exciting place to be. We think that baby boomers and that transfer of wealth and businesses that's occurring right now and over the next 5 years is going to create a lot of opportunities for investments in that space. So it's strong, certainly, very exciting right now, but the future is pretty bright.
I think for investors looking to invest in Trinity Capital, it's a chance to invest in the future of many, many different companies and industries. Looking at your portfolio, like you said, you have a lot of high growth potential companies, from AI to aerospace to some medical companies as well. Talk about what kind of growth you're looking for in the people and companies that you're lending to.
Sure. So we come in really kind of late stage, pre-IPO, pre-M&A. That's where we begin. And these companies have raised tens of millions, if not hundreds of millions of dollars to develop a really interesting new product to attack an old archaic industry. And they have real technology, real IP, patents, enterprise value. What they're doing is really fundamentally kind of changing. It's either they're able to create that product for less, and it's twice as effective. And so we're coming in, and typically, you mentioned AI. I mean, that's a really exciting space too right now. We're not really taking gambles or taking risks on AI or the operating companies that are trying to build and create revenues in that space. We do more of the picks and shovel financing. So we started as an equipment financing business. It's still a big part of what we do right now. And so in the AI space, what we're doing is we're going into the data centers. We're providing financing for the GPUs, the NVIDIA servers, the AMD servers. We're providing financing for the other CapEx needs they have, power generation, CPUs, et cetera. So we really kind of stay in the peripheral. We don't take that direct risk associated with the industry, but really focus on more of the picks and shovel financing space. You mentioned that. That's obviously very exciting right now. We do a lot in kind of that lower orbit satellite launching. Rocket Lab is a big customer of ours, borrower of ours, and we're mostly providing equipment financing. Those industries, as you can imagine, have significant CapEx needs. They're building things that require large tools, machines, manufacturing lines, and so we're doing a lot there. And then, I think the other thing that I'm really excited about is just manufacturing in general. We're seeing a lot more manufacturing come back to the US. This has been a trend for multiple years. You have a lot of investment going into CapEx heavy companies, and they require a lot of financing. And so we're positioned really well to help build out manufacturing capacity here in the US.
Let's talk about the potential risk or benefits for investors who might be interested in investing in Trinity Capital. What's the risk of repayment, and how have you worked as a company to kind of lower and mitigate the risk on that?
So a couple things. We really do limit our exposure to any one credit. Less, I don't think we have a credit right now over 3% of the portfolio. We keep industry concentration limited. We are senior secured on the vast majority of all of our loans. We're secured against all assets, so we're a priority in payment to those companies. They've raised significant amount of equity. They're sponsor backed, either late stage VC or significant private equity backing. We only lend money to companies that have sponsors around the table with capacity to continue supporting them. These are short-term loans, so anywhere from 24 to 48-month terms typically. So we're getting off risk quickly. From a company perspective, we sit at pretty low leverage. We hover around 1-to-1 leverage. We have continued to over-earn the dividend. So for investors, we have 19 straight quarters of keeping the dividend steady or growing while continuing to earn above and beyond rate exposure. I think that we're really positioned well right now in the event that rates drop. The majority of our debt is floating, and so we actually see some benefits. If rates decrease, our cost of capital will go down. And then 90+% of our portfolio, this is all, you can find this in the schedule of investments, has floor rates that are above 12%. So we think we've positioned ourselves really well right now to continue to be a real consistent dividend and income play for investors. I think right now the dividend yield is pretty high, 14-15%. That's really more of a reflection of just the stock being low. And we think it's a great entry point for investors who are interested in real consistent income. And then maybe one other just kind of risk mitigator. Since 2008, we've continued to see 26 basis points annual loss rate. That's a very low loss rate since 2008. And then we get warrants in more than half of the loans that we issue. Those warrants since 2008 have actually created realized gains that have offset losses and created some upside for investors. So we actually have a net negative loss rate since 2008. So something else investors can look to and point to just to say, hey, of course, the future is not set based on what's happened in the past, but we have a pretty good history of keeping losses very low, in fact, negative.
That's very good to hear. And I think your portfolio itself speaks for that success rate. You have a lot of really big name clients. You've mentioned a few, and also keep increasing the amount of money that you're lending every year. Can you go through just a few of the stats from your recent report of just how many loans you've got out there?
So we've got a portfolio around 100 companies, a little over $2 billion in assets. That continues to grow. Earnings have grown ever since we consolidated our business into a BDC in 2020. Since then, we've continued to increase earnings each quarter, 19 straight quarters of growing or keeping that dividend steady. We saw net investment income continue to rise yet again. We feel pretty good about where the portfolio is at right now. We continue to see our portfolio strength. We do value the portfolio from a third-party valuation perspective quarterly, and that's continued to stay steady. One of the main things I think investors should know with our company is we're not just a pool of assets. When you're looking at BDCs, business development companies, the majority of them are a pool of assets that trades publicly. We are actually a management company and a pool of assets. So we do not have a manager. There's no management fee that's charged. There's no incentive fee that's charged. I own the same shares as any one of our shareholders, and that makes us pretty unique. We sought SEC approval last year to have the ability to own an RIA, and so what that means for investors is we have this public company. It's continued to perform very well. We also have an RIA where we can go out and we can raise third-party capital, which we've done. So our public company manages third-party private capital, and we can charge management fees and incentive fees. So one of the reasons why you're seeing earnings grow, why you're seeing our ability to increase earnings above and beyond the loans that we issue, is that we actually are an asset management company as well. And 100% of those management fee streams are owned by our public shareholders. And so this is new. This is newer for us over the last couple of years. You're starting to see the benefits of it flow to our shareholders. Most of the market doesn't get it yet. They don't quite understand it. Now, there's not a lot of other BDCs doing it. But what it does for us is it gives us the ability to not just be a consistent dividend play for investors, but also to be a growth story in the stock as well. So that's our goal long term. We want to keep increasing the earnings for investors. We want to be really steady, yes, but we actually want to continue to increase now. We want to continue to increase the dividend in earnings over time.
That certainly helps to differentiate your company from other competitors out there. Kyle, this has been a really great conversation. Is there anything else that you'd like to share about what makes you excited about the future of Trinity Capital? I know you came on as CEO this year, but you've been with the company for a long time. Again, you've explained a lot of it already, but anything else that just gets you excited about the future and where this company is headed?
Yeah, I mentioned it, but our ability to continue to raise private capital and really grow the asset management side of our business it's meant to be a huge boom for investors who can get into a stock, who can expect that great quarterly dividend, and who can see their returns grow over time. And that's going to be really unique to us and a big differentiator for us relative to our other BDC peers. And so I hope investors see that. I hope they get excited about that. And I think the future is really bright. The opportunity for growth is there. And we're doing it in a way that's really accretive and good for investors. And so, yeah, thanks, Bridget. Appreciate you having me. And to all your other stakeholders and investors out there, we'd love your support.
Thank you again, Kyle, for your time today. And thank you for watching Market Beat. You can find more videos just like this one on our channel. Thanks again for watching. And as always, happy investing.